Hey, what's up guys? Today I wanted to show you how you can lend and borrow your crypto using Aave. You can see here Aave is one of the largest DeFi protocols. If you go on DeFi Llama, it's currently ranked number 2 and it fluctuates between like 1 to 2 here, but it's one of the safest protocols that have a really good track record. And if you're new here, my name is Richard. I'm a yield farmer and investor. I've made over 6 figures in crypto, and a lot of it is thanks to yield farming. If you want to take a peek at my portfolio, you can look at this portfolio update playlist here. So the plan for this video is to go over the beginner strategies first, and then talk about a few advanced strategies like looping, the bull lever, the bear lever, and yield arbitrage. And I'll also talk a little bit about the pros and cons of each strategy so that you can know the risks and make better decisions. As always, this is not financial advice. Please do your own research before making any investment decisions. So right off the bat here on the markets tab, you could see this core instance, meaning that we're on Ethereum mainnet. This is where you will have the most options here, but if you have smaller capital, you might not want to use Ethereum mainnet. And here you can see the list. These are basically EVM chains, and you can basically go into the market that you like. And some markets would have better yield than others. And you can see a ton of commonly used assets here like Wrap Stake ETH, Ethereum, USDT, USDC, Wrap Bitcoin, Coinbase Bitcoin, right? And then a bunch of other liquid staking tokens, as well as altcoins like Aave and Chainlink. So there's a lot to choose from. And for this video, I will use Arbitrum because I have some USDC on there on my hot wallet. And I can either enter my position from here if I click on the details tab or go to this dashboard tab here. I will be able to see my assets as well as some of the assets that I could borrow on Arbitrum. And if I want to get a better picture of the APY, I could go in here and then click details. What it's going to show you is the average APY over 1 month or over 1 year. And the main difference between APR and APY is that APY is already including compound interest. So this is this number here. And this supply APR here is not including compound interest. So what you're going to see is that the interest rate would fluctuate by a lot. And what you can earn when you supply or what you have to pay when you borrow is depending on this utilization rate here. So if more and more people are borrowing stablecoins, for example, then the borrow APR is going to be higher and higher, right? The reason why it's designed this way is because a ton of people are borrowing. There's a lot of demand, so then you have to increase the borrowing cost to kind of encourage people to pay back the loans, right? So the rates changes all the time. In December, when a lot of people were borrowing stablecoins to go long in the market, you could see the rates spiked above 10%, but currently it's sitting around like 4 something percent right now. Not really life-changing, but it's a good way to save your stablecoins and put it to work rather than just letting it sit in your wallet. And the rates would depend on which market you're on right now as well. On Arbitrum, less people are borrowing, so the interest rate is not that high, but you can compare different markets when you actually deploy, right? So here I want to supply. Let's say I want to supply $100 for this example. What I have to do is approve my asset here so that Aave could withdraw my USDC. I like to use Pocket Universe to help simulate these transactions and protect my wallet. I hit continue, and here Rabbi also tells me what's going on. I'm basically max approving in this case, and you guys can edit this number if you just want to approve the amount that you want Aave to withdraw. If that looks good, I will hit sign, confirm, and then once it's confirmed, I can supply my USDC here. And here you can see the simulation shows me that I would receive like a placeholder token that would basically say that I have $100 that is deposited into Aave. And if this looks good, I will sign once again. So after I deposit it, if I go to this dashboard tab here, you can see I would be earning this amount of APY. You can see this is the asset here that I'm supplying, and I could withdraw this at any time, right? And before I show you guys what I can borrow, I want to actually look at this. What we have to worry about when borrowing assets or trying to use leverage is this liquidation threshold here and this LTV ratio here. LTV stands for loan to value ratio. it means that if I deposited $100, I can borrow out a maximum of $75. But if the asset I borrow out moves up in price, then the $100 that I deposited would be liquidated. Then I would have to pay back my loan, and then I also have to pay this 5% liquidation penalty on top of that. So when we borrow our assets here, we definitely don't want to go anywhere near the 78% mark to avoid the liquidation, right? So in this case, if I'm supplying USDC, it means that I want to accumulate more USDC. If I want to borrow an asset like Ethereum or wrap Bitcoin, then I'm basically short that asset, right? So I could show you guys how to do this here. Let's just say I want to borrow 0.01 Ethereum. And what it's going to show here is this health factor. If my health factor drops to 1, that's where I'm liquidated. Where Ethereum rises in value enough to basically reach that 78% mark, right? So I can do here right now, I need to approve, confirm, and then here I could borrow some Ethereum just to show you guys and confirm. So all done here, I've supplied USDC and then I've borrowed some Ethereum in this case. And depending on what you guys want to do, you could sell the Ethereum and then loop it here to basically add more collateral here if my goal is to be short Ethereum, right? So that's the idea here. And same with any asset, you could look into each asset and see the average borrowing cost. For example, over the span of 1 month, it will cost me about almost 3% to borrow Ethereum, which is less than this APY I'm earning in this US dollar terms, right? So now that you guys know the absolute basic, let's go over some more intermediate and advanced strategies. And if some of these go over your head when you first watch it, don't worry about it. Just try using Aave with a little bit of money. Then you'll slowly get a hang of it, or rewatch the video multiple times if you need to. But basically, the first strategy that I want to show you guys is this looping strategy. What I want to do is, if I want to go long on Ethereum, I want to be lending out my Ethereum, right? Then I borrow stablecoins here. And then after I borrow stablecoins, I'm going to swap to Ethereum. Then if I just want to use a simple looping strategy, I would then add this Ethereum that I swap into this collateral side as well. So the benefit of this is it allows me to accumulate more Ethereum without having to sell my assets or without having to put more money in. As long as Ethereum moves up in price, at the price point that I do this, I would be profitable long term, and I could sell my Ethereum later on when the prices appreciate. So let's take a look at some numbers here, and let's just think in US dollar terms just to keep it simple. Let's say you're lending out $100 worth of Ethereum, right? With this looping strategy, let's say I want to borrow like $50 in USDC, right? And this is the Ethereum side. And what I want to do is swap to Ethereum here with my USDC, and then I could loop it back here. So then the new balance would be $150 on the collateral side, and then I would owe $50 worth of loan, right? This is basically called looping, and then you could repeat that process over and over again if you want to. So at first I borrow like 50% of what I deposited, right? Now I have $150 worth of collateral. If I want to borrow more, I can do that. Another 50% on that is $75, right? But because I already have $50 here, then I would borrow another $25 here to do the same process as before, swap it to ETH and then add back to this collateral side. So then the new total would be around $175 and a $75 loan, right? So you can repeat this as many times as you like, as long as you keep a healthy loan to value ratio. I personally don't like to go over 40%. That's like the hard limit that I like to set. But typically 20 to 30% is much safer. And before you do this, you gotta know your liquidation point as well, right? Let's say you would be liquidated at 80%. What I want to calculate is this $75 divided by 0.8. And you can see this dollar value here. This means that the Ethereum that I lent out, if it drops to like $93.75, then I would be liquidated, because 80% of 93.75 is this $75, right? If we multiply that by 0.8, you can see it's $75. But 93.75 is roughly like 40% to 50% drawdown. So it's relatively safe if you don't expect Ethereum to drop by 50%, right? Right now, Ethereum is a little bit extended. It's trading above $4,000. So I would not personally be running the strategy currently. But if Ethereum drops to like $2,000, for example, and I want to buy more Ethereum, that's a very simple strategy that I could run. And if I want to know the current LTV, I just take 75 divided by 175, and you can see the current LTV is above 40% at around 43%. So a little bit risky here with this ratio. But what's really good about this strategy is, let's say Ethereum increased in price by 2x. Let's say you did this when Ethereum is trading at $2,000. Now it's trading at $4,000. What's really cool is this collateral side would jump up to like $350, right? You can sell some Ethereum to pay back your loan here. So then your net value would be around $275, right? So this is more profitable than just holding this $100 worth of Ethereum. If this 2x without any loan, then you would end up with $200, right? Compared to this $275 here. So this is what a lot of people do with a simple lending and borrowing strategy. When Ethereum is really cheap, that's the best time to do it. But again, you gotta keep in mind that you will have liquidation risk. And if we want to basically go short on Ethereum or Bitcoin, we're going to do the exact opposite, right? What we want to do is lend out some USDC, and then we borrow Ethereum here. We swap the Ethereum that we borrowed out to USDC, and then we add the USDC to this lending side once again. Again, this is called looping if you do it multiple times. And the reason why you add more collateral on the lending side is to have a lower loan to value ratio, which makes it harder to get liquidated, right? So that's a very simple strategy that you could follow. And a more complex strategy is if you are yield farming like me, what we can do is we lend out our Ethereum. We borrowed some USDC here. And what we can do is it generates the fees, right? We could use the fees to pay back the loan, to decrease our risk, or to add to the collateral side to make it safer to keep that leverage position open. The benefit with this strategy is that you're not going to suffer impermanent loss on the lent crypto. Unlike a normal ETH to USDC pool, right? If you just stick your asset in there, whatever Ethereum that's in the pool is going to be slowly sold to USDC. Compared to this strategy, you will have less asset appreciation, but it's lower risk if you're not using leverage. There's more upside compared to simple crypto to stable pool, just because of the reason that I mentioned. As Ethereum moves upward, your Ethereum that you lent out is not being converted. Whatever that is in the yield farming LP is being converted. And again, as long as Ethereum is moving up and the prices are trading above your entry, whatever LP value you have here, as long as you stick to like a safe range and you're not doing some like wonky stuff with like range chasing and more complex strategy, your LP value would also rise as well, right? So it's going to make it really easy to exit this position, and it's going to be more profitable than a simple crypto to stable pool. It's still profitable if the market just moves sideways. Right now, Ethereum is at $4,000, right? If it just keeps grinding sideways for like 6 months and you have this strategy, it's still going to be very profitable. You can decrease your risk over time if you pay back your loan. And I typically do that if I'm running a leveraged position. I don't like to keep it open for too long and just have a bunch of loans that I need to pay back. The risk is adjustable depending on the ranges you set. For example, right now, Ethereum is trading at 43.72, right? And if you guys run really tight ranges from like, let's say $4,000 to $5,000, you might be able to earn a ton of fees, but that's going to be really high risk because let's say Ethereum drops back down to like $3,000, you're still going to owe that USDC that you borrowed, and you got to worry about the liquidation point, right? Versus if you have a wider range, let's say at like 2,000 to 6,000, if you're still trying to get some nice fees, if Ethereum drops down to $3,000, we could still withdraw our liquidity, pay back some loan with the USDC, and then add the collateral to this side with whatever Ethereum you have left over. it's going to be safer than a tight range, right? So depending on the risk that you want to take, you could either go with a tight or a wide range strategy. The downside is there's liquidation risk. So make sure you guys run your numbers before you actually deposit. There's more smart contract risk because you're now interacting with lending and borrowing, as well as different protocols like Uniswap to yield farm with. You have to pay higher interest on your stables. If you guys go back to this Aave tab here, stablecoin interest is usually higher than like Ethereum's interest or Bitcoin. So if you don't pay back your loan, a lot of these interest rate over time can eat into your profit margin. It's typically lower APR because now we're not really putting our whole capital into the liquidity pools. What we have to do again is, let's say you have like 100K worth of Ethereum, you deposit that, you can only borrow like 30 to 40K worth of USDC that you're yield farming with, right? So even if you're earning like 50% APR with the USDC you borrowed, that's only 30 to 40% of your capital. So that's something to consider as well. It's best for when crypto prices are cheap, when there's a crab or a bull market where you could be reasonably certain that the prices are going to bounce back or keep trending up over time. And it's great for a blue chip focused strategies because when the prices bounce or trend up really aggressively, our capital that we lent out is not being sold, right? If you have other spare liquidity to deleverage, it's also a great strategy. And with this type of strategy, I personally don't put all of my capital into it simply because I want to have the option to sell my other holdings for a profit or for a loss to pay back my loan if I really need to. So that's the bull lever here. And the bear lever is simply the opposite. What we're going to do here is we're going to lend out stable coins, borrow Ethereum to yield farm with. And if Ethereum drops back down to $3,000 and you're yield farming with, let's say, a $6,000 to $2,000 range, what's going to happen is your LP value would be in Ethereum profit. You could choose to close it out, pay back the Ethereum loan that you have, or just keep the position open and pay it back over time. But basically, the idea here is whatever you're lending out, you're long on that asset, and then whatever you're borrowing out to yield farm with or to swap into other asset, you're basically short that asset, right? The benefit is there's no drawdown on the lent stables. So if you guys want to position short in the market, this is a great way to do so because Ethereum would drop in value over time. It's going to make it easier to basically buy back the Ethereum and pay the loan at a net profit. You profit from the market dump. There's not too many ways to like make a lot of profit when the market goes down really rapidly. This is one of the best ways to do so. It's still profitable if the market just crabs sideways. You can decrease risk over time if you pay your loan. And this is especially good if you combine it with like other crypto to crypto pools. For example, wrap Bitcoin to Ethereum, right? Because a lot of times those pools is generating Ethereum in the process. And what you can do is if the market just keeps drifting up, you could use those fees from other pools to pay back your loan, right? So it's much safer if you guys don't like use your whole portfolio for this. And the risk again is adjustable depending on the range you set. I like to set mine pretty wide. I don't really like tight ranges that is like only like $500 on each side for Ethereum, for example. I find that I have much more success with wider ranges. The downside, again, is there's liquidation risk, more smart contract risk. There's no crypto exposure once the price exits your top range. So that's something to consider as well. Again, that's why I personally would use crypto to crypto pools in combination with this strategy. Because if I'm wrong about the market drawing back down, I'm basically protected to the upside if the market keeps drifting upwards, right? So it's best for a crab market or a downtrending market when the prices are high and the market is overheated. This is a strategy that you can look into and try to basically work the numbers, see if it's suitable for your own strategy. And again, it's just really powerful if you use it in combination with crypto to crypto pools, or if you have a big HODL portfolio, whatever Ethereum or Bitcoin that you plan to hold for like 10 to 20 years, you still want to have some of that. Because if you guys are investing like long term, we definitely don't want to sell all of our assets just because like you could get sidelined, right? The way each cycle has played out is that the market basically goes on an uptrend for about like 4 years before like drawing back down pretty aggressively. But nobody knows the future. Who knows what the market is going to do in the future, right? If the market just keeps slowly grinding upwards, like what we're seeing with the stock market, if you look at the chart of SPX, right? If you're trying to go short on some of these points and you miss your re-entry, you're going to be sidelined and basically lose out on like the amazing runs. I personally do not plan to short the market with my whole portfolio. I don't think that's a great idea. If I'm into stables, I probably would run at least like 50 and maybe all the way up to 75% stables, borrow some Ethereum to yield farm with. But that's pretty much like the maximum that I would go because I still want exposure to crypto long term. And the last strategy that I want to show you guys is the yield arbitrage strategy. What some people do is they find like a higher yielding stable coins. And let me show you guys this in this core market here. And what a lot of people do is they find the higher APY stablecoin like USDT, and then they borrow out a lower APY stablecoin like USDC or this RLUSD or DAI, and then swap it more into the higher interest one to basically loop and earn a leverage yield on stablecoins. So this is what some platforms do for you automatically, like Contango. Some people really like that strategy. I personally don't like it too much because I don't want to keep an eye on the interest rate. If the interest rate fluctuate by quite a lot, you're going to be losing money, right? You can see, for example, DAI to USDT on Moonwall, or some of these like PTTUSDE that is paired with USDC on Morpho. And again, when you guys are interacting with these protocols, you're basically taking on more smart contract risk. But the benefit is the potential APR that you can earn on stablecoin is really high. Again, I personally don't use that strategy too much because I personally don't like to spend the time to keep an eye on like the interest rate fluctuation. It could be worth it if you guys have like a few hundred K or like a million or two to basically run these stablecoin strategies. But again, the main risk that we really have to worry about is this interest rate fluctuation. Let's say you're lending out USDT, it's earning you 8%. You borrow DAI that is costing you 6%. You add leverage to that to basically earn a higher return. But the problem is if the DAI interest rate spikes to like 7 to 8%, while the USDT interest rate dropped to, let's say, 5% because of whatever reason, then you would lose that money in the process, right? So you got to monitor your performance and close out positions. And Contango charges you a fee as well. So it could take you a few days to basically make up the money that you invested. Just another option for you guys to consider. But for most people, just lending and borrowing should be good enough. So we went over a couple things, right? How to lend and borrow, how to loop your assets, as well as the bull and bear lever strategy. I hope that was helpful. But make sure you guys know your liquidation point and do your own research, run your own numbers before you deploy. If you guys want to learn more about yield farming and investing, be sure to check out the other videos on my channel. Thank you once again for watching. I'll catch you next time.